Hello, my name is Cameron Jacoby. Thank you for clicking on my video. I appreciate it. Today, I'm going to be going over a really basic understanding of a pretty basic concept in infinite banking. We're going to be going over the debtor, the saver, and the wealth creator. So, before we begin, I would like to read you this quote from Nelson Nash that I believe really does embody the concept. Plan as if you were going to live forever and live as if you were going to die today. With that, first of all, what is it? What is the debtor? What is the saver? And what is the wealth creator, right? So, in basic terms, really, there are three different types of spending habits. And I'm sure everybody knows at least of two of them, the debtor and the saver. But up until recently, I've really begun to understand the wealth creator, the hidden third door in the room, really the golden option I found. So when we're going through this, I want you to think of three questions. Which one are you? Which one am I? Which one do you want to be? And probably the third most important one is, how the heck do I get there? Cam, you're telling me all this information, and it could be so great, but how do I get there? At the end, we're going to answer that. So first of all, the debtor. What is the debtor? The debtor is a person who is always in debt. They never save any money. Any of their entire paycheck goes in through their personal economy and comes out. They don't save. They spend 100% of their income. And their major capital purchases are made with a credit card. And we define over at Alpha Mega Wealth, where I work, we define a major capital purchase, or an MCP, as something that you cannot purchase all at once. So something that traditionally you would pay in multiple installments. So this is a pretty basic outline of the debtor. As you can see, they're always fighting to get back to that zero line. So they don't have any savings. They borrow to live their life. Their income is to meet their basic necessities, or they do what they want to do. But if they ever want to buy a car, they ever want to go on vacation, they go to college, anything like that, they usually go to a bank, or traditionally a bank, or they get credit cards and they use credit to purchase what they want to purchase. And a lot of people say they don't have collateral in this type of transaction, but they do. Because in this case, they're using their future income or their future earnings as collateral. If you think about it, if you go to a bank and you're looking for a loan, they came up with really fantastic words such as a credit score or a FICO score to determine your interest rate on a loan. But what's funny about that is, if you or I, we have a friend who never pays us back, and they say, "Hey, would you mind if I borrow $100?" Are you going to be giving them that $100 if you don't anticipate them paying it back? No. And if you think about it, banks deny people as well. So if you apply for a loan at a bank and they give it to you, they believe and they know you're going to be paying it back. So these debtors, they live their life paying off debt. Now the saver. So my family personally, my parents, my grandparents, they were always the saver. And there's nothing wrong with that. There's nothing wrong with really being the debtor either. But the saver avoids debt at all costs. They will do anything they can to not go into debt, which, okay. They often have a savings account, checking accounts as well, but a savings account for savings. And traditionally, they do have something in a 401k or an IRA for savings, but that's not really saving. That's actually investing, because those dollars are, one, tied up where they can't touch them till they're 59 and a half, changing to 62. And it's in a risky environment. It's in the stock market. So that's not really saving. So we at Alpha Omega, we define saving and investing as two separate things. They save for their major capital purchases. So traditionally, a saver will save their money, and then they'll liquidate all of their saved dollars, whether they're buying a car, buying a new home, going on vacation, etc. So here, like the debtor, here's the saver. But when they purchase something, they don't think they're, well, at least they didn't have to finance it, they don't have a payment. Really, you are. When you're purchasing something, your collateral, in this case, is your past earnings. In this case scenario, the debtor uses future earnings, and the saver uses past earnings or previous earnings. And in this case, what I want you to realize is if we take a look at the debtor and the saver, where do they both end up? At that zero line. So neither ever really get ahead. It's just, did you already have those dollars before or after? And of course, with the after, you don't have a payment. But what else does that mean? When you, for example, let's say you have a $30,000 car and you have $30,000 in savings. You could take that $30,000 in savings and use it to purchase the car right away. Now, in that case scenario, what happens? The second you drive that car off of the lot, boom, it's not worth $30,000 anymore. What's it worth? Like $23,000 right now, as of 2021. Who knows what it's going to be worth in the future? And when you make that purchase, those are dead dollars. You just bought an asset, but I don't really call it an asset. I call it more of a liability because it's not cash flowing back to you. You're not getting a return. Heck, you're not even going to be able to get the money you just paid in to purchase that asset. So you lose the opportunity to earn interest on those dollars you just used to purchase that car or that home or to go on that vacation. That's the opportunity cost. And another major characteristic of the saver is they have savings and they do have some investments in those illiquid products. So that 401k, that IRA, hardworking people put money into those products and they can't touch it. And as you can see here, given that a lot of the time the saver does move back to that zero line, having that 18.5 potential $1,000 that you put into a 401k could be rather useful. Now, I'm not saying don't contribute at all. That's an entirely other debate or another conversation, I should say. But understanding, yeah, you don't have a payment, but you also don't have any other dollars to make more money. One of Robert Kiyosaki's first principles in Rich Dad Poor Dad was the rich don't work for money. They make money work for them. And if you take your dollars and you throw it right away into an asset or a car or a home, they're not making dollars if you're using that. So what's this third way? Probably the big reason you clicked on this video or you watched this video, the wealth creator. What is the wealth creator? Well, they use their savings as collateral. Now, what does that mean? Really, what they're doing is they're saving money because step one is always to save. You need to save before you do anything. But, well, by the way, when they're saving, they have it in liquid accounts. So it's there and they can access it at any time, which is extremely, extremely, extremely important that they have access to their money. But when they make those major capital purchases, they're made through saving to borrow. Here's another example. If you have $15,000 in an account and you want to go potentially buy a car for $10,000 in this example, you could borrow potentially $10,000, maybe put a little down payment on, but you could borrow $10,000. And if you think about it, if you have $15,000 in savings and you owe $10,000 at, we'll say a 3% interest rate, whatever that would be, $300, $10,300, are you really in debt? The answer is no, because you still are $5,000 above anyway. But on top of that, you maintained $10,000 or above to do stuff with, to potentially go out and invest in the stock market or invest in yourself. start a business, something like that. So the wealth creator consistently grows their wealth. And if we take a look at their chart, like I said, they save to borrow to buy. These people understand the power of compounding and compound interest. That's the opportunity cost. As you can see here, they're saving. This green line represents saving, and the red represents the borrowing. And they're using their savings, and they're building that savings, that nest egg, if you want to call it. And they're using debt to finance some things in their lives. And as time goes on, and they're not liquidating their savings, as you can see, their savings are going up because they're not liquidating that. Because they're using someone else's money to buy things or live their life, their wealth continually grows. So what does that do? That creates a long-lasting, everlasting pool of wealth and wisdom that exceeds one's lifespan. Imagine this. You're 30 years old, and you have a kid, and you start doing this over time. And you start building and building and building wealth, and you use this mentality, this way of spending money, this spending habit. What happens? Every time you buy a car, your savings grow. Every time you buy a house or you're getting ready to send your kid to school or something like that, your savings are still growing. You're not liquidating your tank, we'll say. But on top of that, when you do pass away, because unfortunately that's something that happens, if you teach that, your family will be significantly better off because it can only go up if you know what you're doing. Making sure you're saving and understanding how collateral works, understanding opportunity cost, and passing that knowledge down to the next generation. So with that, I have a question, as in, who do you want to be? Are you the debtor? Are you the savior? Maybe you're already the wealth creator. That's okay. If you're happy with your life and you think financially you're in a good spot, that's amazing. And I'm so happy for you. I think that is the real reason I'm making this video, because I want people to feel comfortable. Life is stressful enough. Having to worry about the financial side of it as well, on top of all your personal relationships, your potential job, if you have one, it's stressful. So my job, I feel, is to pass this knowledge on and help people understand that there is a third way. But if you're here and you're saying, man, I'm a debtor, and really think being the wealth creator sounds like a better path, or if you're the saver and saying, man, I guess that does really make sense, and maybe I could do that. And really, you decide that being the wealth creator is for you, what do you do next, right? So your next steps would be, one, to contact me. So one thing I do is I help people understand how this works, and I help them through that process. And we talk about it, and we have multiple meetings. And it's a great way for not only me to get to know you, but to me to help you and to see you grow and watch you prosper as a person. And what's great about this is it doesn't matter how old you are or the situation you're in, barring some poor situations, of course, but everybody should be saving in some way or another. So if you're a debtor and you're not saving, start to save a little bit. Should everybody be investing? We at Alpha Omega say no. Before you invest, you need to make sure you've saved first, because savings, you can't afford to lose those dollars. In investing, when you put money into these IRAs, these 401ks, you can't touch it, and it doesn't benefit you. Long term, sure, potentially, depending on the tax rate of that time. But if this speaks to you, please, please, please feel free to send me an email. Let me know your name and how you came across this. And the second would be to buy and read Becoming Your Own Banker by Nelson Nash. The initial quote I had was from that book right here. I've read it probably 4 or 5 times now. And read it again and again, ask questions, talk to your peers, see what they're doing and really find out how great this is and how life changing this method could be. So, with that, thank you for watching. Please feel free to reach out. My email is there. So, yeah, thanks for listening.